Over the last 100 years, the stock market has gone up 73 times. That means that you have a 73% chance of the stock market going up. What if I told you there is a strategy that would allow you to increase that 73% to 94%? In this video, we're going to share with you exactly how we do it. My name is Matthew Copley, President and CEO of Copley Financial Group, and I want to help you maximize your income and minimize your taxes. Over the last 100 years, the stock market has gone up 73% of the time. That's a pretty good win rate. When you start thinking about investing, if you can win 73% of the time and you only lose 27% of the time, that's a pretty good investment opportunity. But there are products available out there that would allow you to increase that win rate from 73% to 94%. And how we do that is we use a buffered index portfolio. The way these products work is we are able to get a good return in the stock market subject to a cap. So for example, we might have a cap of anywhere from 15 to 20%. So in the event the stock market goes up, you go up with the stock market up to that cap. The current one available today as I'm recording this is 19.25%. That means if the stock market goes up 10%, you get 10%. If the stock market goes up 19%, you get 19%. If the stock market goes up 30%, you only get 19.25%. Well, in exchange for giving up that amount above 19.25, we're able to buy an insurance policy or a buffer on the index. Now, the way the insurance policy works is if the stock market goes down, you actually get the inverse return, which means if the stock market goes down 10%, not only do you not lose, you make 10%. If the stock market goes down 15%, not only do you not lose, you make 15%, all the way down to negative 20%. Now, if the stock market goes down 25%, you just get a 20% reimbursement. That's the maximum reimbursement. So if the stock market was down 25%, you would still be down 5%. Now, when you look at this portfolio and you think about all the different returns that you can get with the buffered index portfolio, and you look at the number of years the stock market has gone down, you actually change it from 27 down years to only 6 down years, making 94% of the time a positive return. And even better, the 6 years that are down more than 20%, you get a full reimbursement of 20%. Even in like the worst case scenario, like 2008, when the stock market was down 37%, you would only be down 17%. Not a bad position to be in after a major market correction. Now, why I like this product so much for our clients, especially retirees, is because if you look at all scenarios, it works for their overall retirement plan. What if the stock market is down 25%? Well, they're still going to be down 5% because they get a 20% reimbursement on the 25% loss, but that's not a bad thing. If everyone else is down 25% and they're only down 5%, it's a good time to invest back in the market while it's cheap and you didn't lose much. Now, what if the stock market, say, was down 15%? Well, that's a fantastic win because not only do you not lose, you make the inverse return. So now you turn that negative 15% into a positive 15%. Now, what if the stock market, say, is up 15%? Well, you're going to go up just along with everyone else up 15%. It's just like being invested in the stock market. Now, what if the stock market is up 25%? And you're only up 19.25. Well, you don't have to be greedy. 19.25 is enough. It matches our retirement goals. It allows us to get the returns that we want in the market, but more importantly, It helps protect us from those years that really can have a negative impact on our retirement. And it is important to understand that people in retirement need enough years to make back potential losses. If you go back and look at the stock market over time, for example, the Dow Jones, January 1st, 1964, opened at 800. January 1st, 1981, the Dow Jones opened at 800. That's 17 years of the market going up, down, up, down, up, down, and ending up right where it started. Now, someone who's 30 or 40, or even maybe someone in their early 50s, can potentially stomach that because they have some time to make it back up. But someone in retirement may not have 17 years to wait for the market to produce those kind of results that they need for their retirement. So by turning every single year that is down, but not down more than 20%, into a positive year and getting a substantial reimbursement on those years that are more than 20% down, it changes everything for that retiree's retirement. Now, the insurance buffers and the caps and rates can change on these products. In fact, every few weeks we're negotiating new terms with the big banks that offer these products. So how do you get into one of these investments? Well, they're not a secret. They're actually pretty common. Most financial advisors know about them, and they're offered by some of the biggest banks that are out there, companies like Goldman Sachs and Morgan Stanley. So if you want to learn more about these products, go ask your financial advisor about these products. My name is Matthew Copley, and if you want to learn how we help our clients maximize their income and minimize their taxes and increase the odds of being positive in the stock market, check out our website or check out the description below.